Hi there, I'm Mark Anderson. I'm a mortgage banker with Paramount Bank. Now, Paramount Bank is licensed to lend in all 50 states. And what that means is that I can help you with your mortgage no matter where you are in the country. And what I'm here to talk to you today about are mortgage rates. What are they doing now? What are they likely to do going forward? With the Federal Reserve announcing that it is going to begin tapering its purchase of mortgage-backed securities in U.S. Treasuries, people have a lot of questions. What does this tapering program mean for interest rates? How should you position yourself going into the new year, whether you're looking to purchase a home or refinance an existing mortgage? What does this tapering even mean in real terms that are easy to understand? What other factors are likely to impact mortgage rates going forward? In this video, I'm going to answer all of these questions while providing what I hope are valuable insights to you as you position yourself going into 2022. So to start with, let's take a little temperature on the status quo as far as what interest rates are doing right now. Freddie Mac does a survey of lenders around the country, and what they came up with last week, published on the 10th, and that date is actually very important. They came up with an average 30-year rate at 2.98%, and for their 15-year rates, that came in at an average of 2.27% with 0.6% in discount points. Now, the significance of the date that this data was published is that right after this data was published, probably in real time, I'm guessing by the time this even came out, the rates had already started moving up. We saw day after day after day today of pressure to move these rates higher. Based on what I see in the market right now, my guess is that Freddie's numbers this week, when they come out at the end of this week, are probably going to be 0.125% to 0.25% higher across the board. Despite whatever day-to-day changes might happen, where tomorrow could be maybe slightly more favorable today or vice versa, the big overall force that is going to move these rates is already moving. And in my opinion, it is only going to move those rates in one direction overall, and that is up. It turns out there are actually two key factors that are driving interest rates up, I think, over the next 12 months. One, the obvious one, the tapering of this mortgage-backed security purchase program by the Federal Reserve. And two, we also need to talk about inflation. To understand what the tapering is, I think it's very important to actually go back. Starting in June of 2020, the Federal Reserve began buying on a per month basis $120 billion of U.S. Treasury bonds and mortgage-backed securities. This purchase program was actually heavily weighted toward Treasuries, weighing in at $80 billion per month, with the mortgage-backed securities making up the other $40 billion each and every single month. Now, the logical follow-up question might be, how is it the case that the Federal Reserve can purchase $120 billion in bonds per month? How exactly does that go towards stabilizing the economy? Well, if you look at what really kicked off this whole financial problem that the Federal Reserve was trying to resolve, it started with the COVID pandemic itself, of course. At the time in early 2020, there was an obvious concern over people not going to work, the various knock-on effects of a lockdown economy, and overall there was a level of uncertainty that was palpable. You could feel it in the air and you could see it in the stock market. And in this time of economic instability, one thing helps to resolve that stability more than anything else, and that is cash. You see, what's happening when the Federal Reserve buys, say, a U.S. Treasury bond, is they are truly injecting cash into the economy. As a reference point, I think it's really helpful to contextualize what these U.S. Treasury bonds actually are, and I'm going to do that by making a comparison. If we go back to the two world wars, both of those wars in the United States were made possible, at least in part, by cash injections, mainly by private citizens. It's very likely if you went to go see a movie in 1940, that in the newsreel that would come on before the movie starts, you were very likely to see an ad encouraging you to buy U.S. bonds. The U.S. government brought on various celebrities to go around and make pitches for people to buy these bonds. There was this big, massive push to get everybody on board for the war effort buy these bonds, put money into the hands of the government where it can be used to sustain the war effort. Now, in modern times, with the COVID pandemic, there was not this push to get private citizens on board to turn their cash over to the government to sustain efforts to mitigate the effects of the lockdowns, the effects of the COVID pandemic overall. Now, I'm not trying to impose any kind of value judgment here, but it is very important to point out that the underlying principle is the same. Fundamentally, in order for the government to roll out all of the various stimulus programs that they did, they needed the cash to do that. So where the Federal Reserve plays a role in this is that they can, with a few keystrokes, simply move money out of the Federal Reserve directly into these bonds. While the main motive may have been to simply inject this money into the government and into the economy overall, it had a really nice knock-on side effect in seriously reducing the interest rates that consumers would pay on their mortgage. And you might ask, well, why is that the case? What is it about the Federal Reserve purchasing these bonds that caused the rates to go down? It really just goes back to really basic supply and demand economics. The cost of any asset, when you add additional demand on that asset, that price is going to go up. And what the Federal Reserve did is took a huge position in the bond market. By taking that huge position in the market, they drove up demand and therefore drove up price. Now, as mortgage bond prices go up, if you've watched my previous videos covering rates, you know that bond prices go up, mortgage rates go down. So where things stand now is we're basically 14 months in to $40 billion a month coming from the Federal Reserve into the mortgage bond market. To date, the Federal Reserve holdings in the mortgage bond market total about 30% of that entire market. And what the tapering involves is essentially walking backwards from this 30% position bit by bit each month. Starting in December, what the Federal Reserve is going to do is it's going to decrease its U.S. Treasury purchases to the tune of a $15 billion reduction per month. And at the same time, they're going to reduce their purchase of mortgage bonds to the tune of $5 billion per month. Assuming that they stick to this schedule, this means that from December all the way through August of 2022, the Federal Reserve is going to take its position and bring it down to zero in terms of new mortgage-backed securities being purchased. So back to the basic supply and demand. You all of a sudden have a huge player in the space, a huge player purchasing massive amounts of mortgage bonds that is basically telling the entire economy in advance, hey, we're winding down our position in this to the tune of $5 billion a month. Big picture, barring any other factors that might change the calculations involved here, the Federal Reserve spinning down its purchasing by $5 billion a month is going to reduce the demand for the bonds overall, and that is going to put downward pressure on the price of those bonds. As the bond prices go down, mortgage rates will naturally rise. All right, on to inflation. If it was only the tapering that we were talking about, my general prediction would still remain that rates are going to be under pressure to move up over time. The problem with inflation is that inflation is classically associated with decreased bond prices. And the reason for that is bonds are long-term positions. You're putting in a set amount of cash up front for a very long-term benefit. And if you're in an environment of high inflation, you can actually quantify that the long-term benefit, which is defined up front, is naturally going to be lower the more inflation there happens to be. So essentially you've got, I guess we'll call it a double whammy. The Fed essentially exiting the mortgage bond market, reducing demand, and also inflation, which would naturally cause the prices of these bonds to drop. With all this in mind, I wanted to actually walk through some math to break down what a rising rate environment would look like with respect to the cost of mortgage financing. Where I'm going to start is with the current average rate. Let's just say it's approximately 3.0%. What that translates into is that every $10,000 that you borrow on a 30-year fixed mortgage at 3%, that translates into $42.16 per month. If rates come up to 3.5%, so that's a half a point increase, that same per $10,000 cost on a 30-year fixed mortgage goes up to $44.90. At 4%, we're up to $47.74. I'm sure there's some economists out there that are running some very fancy econometric calculations, and they might say with this degree of certainty or that rates are going to be 3.8% 8 months from now, or 4.375% 14 months from now. But you could run any number of these different models. And the problem with that is that you have known unknowns, you have unknown unknowns, and you just have so many variables that you can't possibly capture with any degree of accuracy in any kind of calculation to predict where exactly these rates are going to go. Fundamentally, no matter how you dress that up, it's guesswork. With all this in mind, what is my advice if you're thinking about taking on a mortgage over the next year? On the purchase side, I want to be clear. I don't think that anyone should rush into purchasing a home just because rates look like they're going up. What you should do in this case is simply plan conservatively. With respect to the price point that you're trying to land at, I would direct that price point around your monthly budget. Given that rates could be higher, the one thing that you can control, after taking a really close and careful look at your budget, the one thing that you can control is the amount that you are going to choose to spend per month. That is your line in the sand. And whatever interest rates are doing at the time that you decide is right to purchase a home, stick to that monthly payment figure. And no matter where rates are at the time, whatever sales price that translates into, that's the price point you need to be at. Let the monthly payment dictate that, not some arbitrary price point that you have in mind. And if you'd like a tool to help you kind of run some calculations, if you're kind of kicking the tires on this potential purchase of a property, let me send you one of my spreadsheet tools. I can tailor it to the kind of general parameters of what you're looking for. You open this thing in Excel, you can actually change the interest rate field to see how different rates are going to affect the overall cost of financing. Just go ahead and text me your email address. Let me know that this is a tool that you're looking for. And one thing that I'll promise you, I am not going to put your email into some sort of auto drip spam campaign. That's not really my style. But just send me your email address. I will send you this tool. I think that you'll find it very useful. Now, for the folks that might be thinking about refinancing, whether it is to lower your current rate or whether it's to pull out cash, as much as this may sound like a sales tactic, I do think that it is very much worth considering that the low interest rate environment we happen to find ourselves in right now, that is unprecedented in so many ways, not least of which is just how long it has lasted. I think you've got to keep in mind that the clock is definitely ticking and that your window of opportunity may be closing. All right, well, I hope that you found that analysis helpful. I hope you got something out of watching this video. I am definitely interested in answering any questions that you might have, whether it's about this video or really anything mortgage related at all. Just hit me up with a comment below and I'll get back to you as soon as I can. You can also call or text me anytime. I would love to be your mortgage guy. I'll take a look at your options. I'll give you some information. Thank you so much for watching. Please do subscribe to make sure you don't miss any of my future content. Thanks so much. I'll talk to you again soon.